Hi, everybody, and welcome back to yet another cracking installment of the Matt Brown Show. This is the private placement perspective series where we're talking about the world of venture capital and early stage investing. With me on the line is the co-founder of Moss Lab and the Seed Lab, Jesse. Welcome to the show.
Thank you for having me, Matt. Good to be here.
Yeah, finally. So for our viewers around the world, Jesse, you haven't heard about you and the Seed Lab and what you're doing from an investment perspective. Why don't you give us the elevator pitch about what you're up to at the Seed Lab, and maybe give us the backstory to how you got your start in the world of venture capital?
Sure. So the Seed Lab is an early stage venture platform that I put together about 4 years ago. The idea was for us to find, really, really great early stage businesses, whether they were pre-seed or they were, sort of launching, or maybe they were just right outside their launch window. Initially we were focusing on the consumer vertical, but we sort of spun off and became a bit more agnostic into our, investment thesis. But let me backtrack 1 second and sort of give a little background on myself, and let you know how I sort of got to where I am currently. I'm a graduate of Cornell University, came out of Cornell, and I spent 17 years on Wall Street. I did the typical training programs at companies like Smith Barney, HSBC, and I decided in a weak moment to go back to business school, because I really, back in the early 90s, I didn't really think that Wall Street was a place, I wanted to sort of hang my hat, for a good portion of my future. So I went back to business school as a way to pivot and learn about other areas of business that may or may not, in fact, I may have an interest in. So I was recruited out of Columbia by Ed Hyman, who had a company called ISI Group, which is short for International Strategy Investment Group, which was, a global macroeconomic think tank. And I was recruited by him, and he was world known, and everyone had told me that if Ed Hyman comes sniffing in your direction, you certainly take that opportunity to work around or alongside Ed. So I did, and I spent about 3 years working for ISI Group, and then went off and had a pretty lengthy career on Wall Street, starting my own company in 2006. That company was sold in 2009 to a Sequoia-backed business off the West Coast, which I went in and became a senior partner. And then we grew that business where I was a senior partner, and we sold that business to Wells Fargo in 2012. Concurrently, when I left Wall Street, I had started an apparel business with a woman who had a tremendous legacy in and around the world of fashion. And she, at the time, was the president of Theory. She had then left to go become the CEO of Prada of the Americas. And she had came to me and she said, look, I don't really want to be doing that much operational and back office stuff in and around the world of apparel. And I said, well, then you're unemployable, because nobody knows you as a designer. And if that's the way you want to go, we're going to have to start our own business. So we did. We launched to much success. The company grew 100+% year over year since inception. But in 2012, I came in as the CEO and chairman of the business. I discovered some internal fraud. We had company employees using company credit cards for personal consumption. And they stole, in a 3 or 4 month period, they stole north of $1 million, which we really relied on, as free cash to help operate the business. And so it was a very, very excruciating time. This was a labor of love for my former partner and I. We're really, really passionate about, the product we were putting to market, but also we identified, a variety of white spaces, and it seemed to have worked. So the demand for the product always remained fairly consistent, but we didn't have the right amount of money to operate the business So we had to go out and we had to raise some money. It was the first time we had gone out, into the world and raised money for the company. So I went out and I cold called David Bonderman from TPG, one of the largest private equity shops out there. And I knew that our product had been selling very well, through a wholesale distribution channel. David at the time was the owner of Neiman Marcus, and that was our biggest vendor. So I thought it was a logical place for me to start, trying to attract some outside capital to help us, operate the business. And, 4 or 5 months to the day, I made my first call to David. David came in and David invested, a significant amount of money and bought 10% of our business. We then sold our business in 2017 to a private equity company out of Chicago. To say that it was a good exit, really depends who you're speaking to. The company had a lot of potential, but from an operational standpoint, it was just a battle every single day. It kind of gave me this, bipolarization feeling, every morning when I woke up to every night when I went to sleep. I really, really learned how to navigate, the early stages of commerce, of business, and, really, really sort of understanding that, the emotional side of being an entrepreneur is really what separates, a founder from a really, really great founder. So we sold that business in 2017, and I had been investing my own capital into a variety of different businesses, predominantly in the consumer vertical. And I teamed up with a woman that I had grown up with here in New York City, very, very smart woman who had founded a company called Daily Candy. And Daily Candy was the first email subscription platform really marketed towards, the female demographic, sort of in the age category of 17, 18 to about 60, 65. She really was really strong at identifying trends, spotting emerging companies, and she had a tremendous track record, sold her business to Comcast for $150 million, call it 15 years ago. So we teamed up, we made some personal investments together, and one day we just sort of said, why are we investing our own capital into these businesses with your track record, with what I have done, which certainly wasn't as great as what she has accomplished. We thought that it was probably the right time to go out and raise some outside capital. And so we did. We put the Seed Lab together. We went out, we raised some capital. We recruited a chairman, for our platform, who also became a co-founder. His name is George Hornig. Spent 30 years on Wall Street as a senior level manager, but had also been a venture investor his entire career. Anyone who left the institutional world, all roads led back to George for a potential investment, a chairmanship position, or some kind of advisory. And so knowing that George had had a lot of success, I knew as a first-time fund manager that I would need someone of his legacy to come in and support, the various initiatives that we're trying to build. Then we recruited a third partner who had been a banker by trade, but had also been an operator. He had been the president of one of the biggest athleisure companies, in the market. But from an age perspective, he was 30 years old. So we built this really vast demographic. From a 30-year-old, George at the time was 65. I split the difference. We had this sort of multi-generational lens from an investment perspective. And so it really gave us, a lot of insight into various businesses out there to determine whether or not my generation would be, an end user of that product. The 65-year-old, their generation would be an end user of that product. And then, of course, the 30-year-old, what they thought could be, a good investment from that demographic perspective. So we built the Seed Lab. We raised some money over the last 4 years. We've invested in 14 different businesses. Everything has to have some kind of sustainability, asset to it. But really, for the most part, what we're looking for when we make an investment into a company is we're really looking at the founders. It's really for us the key ingredient to find someone who really understands the world of being an entrepreneur, to understand that, you know, the light isn't always as bright from the day you start to the day you quote unquote finish, that every day is going to propose various challenges. And so we look for people that are highly communicative. We look for people that are incredibly frugal with cash. We look for people that have a really, really good fundamental path, you know, to some kind of profitability for the company. And most importantly, we look for character. You know, people that we can rely on. As we are now investing outside capital, we have a fiduciary responsibility to our investors to make sure that we do the right due diligence, to make sure that we know these founders, to know that we can communicate with these founders. And when things don't go as planned, that these founders are going to be front and center and not run away, you know, from the issues at hand. So the Seed Lab has been built. We are now currently on our second fund. We're out in the market raising money in a very, very tricky environment. But as we all know, people look for, you know, asset diversification. And as we all know, that early stage venture, you know, we're looking at 5 to 10 years before any sort of liquidity event, if in fact it happens, right? The returns could be great. There's a lot of work. And from our sort of, you know, in our camp, we're all operators. We've all been CEOs. We've all been founders. We've all taken various companies through various rounds of liquidity, through fundraising. We've sat on public and private traded boards. Our human capital, we feel, is as valuable as the money we put into these businesses. So, you know, very, very important for us, you know, to look at a company, you know, from an operational perspective to see if we can help, whether it's financial engineering, supply chain, marketing, branding, brand thesis, and so forth.
Great stuff. Thanks for that. There's a lot of context for that, Jesse. Cool. But look, I want to quickly talk to you about macroeconomics because it's a standing question here. I'm curious to get your view. How much does uncertainty, you mentioned it was a tricky time in the market, how much does that play on your mind in terms of when to cut a check or not?
You know, look, we all have our investment, you know, process. Right. Every fund out there has a different set of criteria, and they all have a different sort of, call it, you know, investment checklist that they have to get through in order to get to the investment, you know, discussion. Right. For us, you know, we stay in our lane. You know, there are going to be companies, like every time that there's an economic crisis, and we're currently going through one right now, you know, with, you know, rising unemployment. You know, we're going through with, you know, an increase in interest rates, you know, globally. You know, we are seeing, you know, a lot of disruption from a macro perspective. You know, for us, it's, you know, for us, it's really about, you know, opportunity. And in any time during a financial crisis, that's when there's been some great opportunity for people to come to market and really do something special. So we're seeing some really, really interesting things currently. But of course, money is scarce, money's expensive. And so we've got to be a lot more conditioned before we write a check. So we spend an exorbitant amount of time with the founders of these companies. We do a very, very lengthy diligence process. And if and where we can't apply our diligence to the company, we have now surrounded ourselves with a group of experts that can really help us understand certain categories that are, you know, within these businesses, to give us that sort of, you know, hockey stick, you know, understanding of what we're looking at.
Mm. So when you think about your LPs, you mentioned you're on your second fund. When things are uncertain like this, how does the macroeconomics affect their appetite for venture stage investing or backing a first time fund or a second time fund? How does an LP view the impact of uncertainty in macroeconomics or in the macroeconomy on their appetite to invest in which is quite frankly a risky venture as it is?
You know, investors, LPs, It's very, very difficult for anybody to go out and raise money for a first time fund. If you're coming from one of the larger private equity funds and you have been the team leader or the deal leader on some companies that have, demonstrated, significant returns and so forth, you can, for the most part, apply that track record, into your fund as a first time fund manager. But for the most part, people get very nervous, that people are coming together, managing money, for the first time collectively. That is a concern. And we shared that concern with our investors. However, from our various individual, track records, but also having someone like George on our platform who is very responsible, has a great reputation, it gave a lot of our investors, significant comfort. But also in our first fund, we didn't raise any institutional capital. It all came from family. It all came from friends. It all came from business colleagues. We didn't do an institutional round. Our second fund, because now we've got a track record from fund one, we'll now start to dip our toes into the investment, into the institutional world for fundraising. But look, the world out there is very, very, very dicey, right? It's very unpredictable. Venture is very, very difficult because, over the last year, 2 or 3, it was a very, very lofty environment. People were throwing money at pretty much every deal. Mm. And now people have to become a lot more selective. And so as we started to see, these valuations just skyrocket, and now that these companies are burning through capital, right? They're going back to the market looking for, new sources of capital. And those sources of capital are not readily available. And so they're now going into these presentations, looking, with valuations that are much lower than their previous round of fundraising. And so that creates a big challenge. Nobody wants to go into the market with in a down round. It sort of demonstrates that your company is not, performing that well. And so there's been margin compression. There's been supply chain issues. There's been personnel situations that are fairly common as people bloat their payrolls, as they're growing. Now they're cutting back. And now you're asking people to perform multiple tasks. And that's a very, very big ask. So the macroeconomy is, it's pretty dicey out there. And I just think that you're going to see a lot more selective investments. But someone like from our seat, we decided that in our second, fund, we're going to look for companies that may be a little bit further along, in their sort of growth. Mm-hmm. So that way we're a little bit closer to some kind of monetization or liquidity event for the business.
Got you. So what's the source of your deal flow typically? And you mentioned team, for instance, as being one of the things you look for in making an investment, and you go through quite a hardcore due diligence process. Well, are there any specific other factors over and above just the team that you feel are important, number one? And then number two, where does it go wrong? Like when someone's pitching you for investment, is there a commonality that you see in terms of they're too aggressive in their projections or whatever the case might be?
I mean, that's a great question. But, so when we meet a company or I meet a company, and I've looked at 200 plus companies in the last 4 years. So now we've become a little desensitized to it because when we first started, everyone tells a great story. Everybody sells their product or sells their platform better than anyone else. And you root for some of these people and you like what they're doing. Right. And part of the venture world is getting to know these founders and being really part of this early stage process. And so are really, really looking at the founders of these businesses. They really, really have to, demonstrate that they are the best of breed. Right. And so the first question that I ask, any founder that I meet, is how much money are you looking to raise? Tell me what the value of your business is. Tell me how you got to that valuation and how you're going to deploy the capital that we're going to raise for your platform. And a lot of these early stage founders, they have no idea what it takes, to get to that next step or that next level, right? And so I've heard a lot of people tell me, yeah, we're looking for, X amount of millions of dollars. And then we go through their deployment schedule. And I realized, well, you don't need 2 million. You need half that. Or you don't need 2 million. You need 2 times that. And so that's a really, really critical thing for us, is to know exactly where every dollar is going to be spent at the early stage, because, it's very, very, very easy for a founder, to think that bigger is better. And it's not always better. Bigger is not always better. So we're looking for founders who are not looking for the largest raise. We're looking for founders who are looking for the right raise. Large equity raises, come with significant pressure, right? And it can distract a founder from important operating tasks, that are required day to day. It can also result in a loss of, fiscal discipline and innovation. And so those are the kind of things that we look for. We really, as I said earlier, it's really, really critical for us to find a founder who's very frugal with their cash, right? And know where every dollar is going to be deployed. Because the more money you have, the more mistakes you can make. And we really want our founders to stay in their lane. And we all know that after 2 years, 3 years, 4 years, it's very, very easy for these early stage founders to sort of come into this malaise, to get a little bit to get a little tired. And all of a sudden they start hearing, how do they grow? How do they get to that next inflection point, right? How do they grow from 10 million to 25? How do they go from 25 to 50 or 75 million, right? Can we do it staying in our lane with our hero products? A lot of people want to start to introduce these ancillary products or get involved in other business lines that they feel are complementary to their core business. And it's really, really important for us to keep our founders in their lane, because a lot of people have made grave mistakes by trying to apply other things into their business model that don't work, and they cost a lot of money. And it's highly distracting for the founder, but also for his team.
Got you. And Jesse, you mentioned you've cut a few checks over the years, and I'm curious to understand, when you think about all those checks that you have cut, what has been your greatest success and failure, and what would you say made the difference? My biggest look. I have failures on a daily basis, right? The success rate, for our portfolio is probably, of the 14 portfolio companies, we've got 3 that are outperforming the other 11 companies, right? We've had, we were investing in a very, very difficult time, in a very uncertain time, COVID. And so we made some mistakes during COVID, but we also made some mistakes as a first-time group, right? At times, our diligence process wasn't as lengthy and as strong as it could have been. Other times, we were duped into thinking that the round of a company we really liked was closing much quicker than it was, and we wanted to be involved. And so, we were learning. We were learning about people. We were learning about the emotional side of early stage investing, right? We were learning about how to deal with LPs, right? Getting calls from, our partners on a weekly, monthly, quarterly basis, asking us questions about the portfolio and having to be completely transparent. And so there's so many companies out there that tell a great story. It's those investors that know what is going to work and what's not, and we're still trying to figure that out ourselves. Yeah, I hear that a lot.
And so from a percent to total, 3 out of 14 companies that are outperforming, if we can monetize 1, 2, or all 3 of those assets, it's going to make up for, the failures or for the misses in the balance of the portfolio. But we have to be patient. We have to stay very disciplined and sort of navigate through this uncertainty in the world today, and pick and choose our spots very wisely.
So, Jesse, what's one piece of advice that you'd like to give a founder looking to raise venture capital in the market today?
I would say this. It's another great question, Matt. I would say don't build your business to sell it. Build it to own it. If you build your business with the attitude that you'll never sell it, then your decisions will always be the right ones for the business. And in the end, you will have built a business that investors are really looking for or looking to really get involved in.
Got you. Jesse, thanks for that. I just want to change gears for a moment and quickly talk to you about capital structures. So when you're doing an investment, is there a preferred capital structure for you? For instance, do you go with the safe notes if they're pre-revenue? Do you price around ever? How do you approach capital structures? Do you have a preference?
It's another really great question. It really, really is sort of dictated by what's happening out in the market. We like to price around. We think that we can obviously defend a priced round because of all the work that we're doing into a priced round. We can demonstrate and show how to get to that, and that's very, very critical for a particular type of investor. So that would for the most part would be our priority, and we look for safe notes are okay, but they're not always the most advantageous. But we like price rounds. We look for companies that we can get there. We can do the work to get to that number.
Perfect. Jesse, we're just going to take a quick break. Got to get our sponsors involved. Just relax there. I'll be back in a moment. All right, okay. Guys. Ciao. The Matt Brown Show is presented by Carafin, an investment bank that offers and supports direct private investments in U.S. operating companies. Over the past 20 years, investors have placed over $1.2 billion of private debt and equity in more than 100 companies through Carafin and its affiliates. Carafin leverages technology to empower its community of investors to deploy their capital far more efficiently than ever before and connects their community of engaged investors with worthy companies. Invest portions of your portfolio in direct private investments today. Visit carafin.com/Matt Brown Show for more. Alrighty, guys, and we're back. So, Jesse, you mentioned you like to price around. How do you value a company? Obviously, there's a number of approaches that are on the table, but obviously, as a founder, you're looking to try and get the highest valuation possible. So, if you can explain how you think you're worth 10 million as an example pre-money, that's great. But obviously, that's in my interest. So, how do you negotiate what fair value is, and how do you price around?
Well, I mean, there's a lot of multiples that are factored into that conclusion, right? There's obviously a supply and demand, box that we like to take a look at. What is the competition doing, right? What is the competition? How have they penetrated the market, right? We like to look at distribution channels, like to see where this product can live, how it's going to sort of demand the most amount of attention and so forth. So, we take things from a much more holistic approach. My partners take things from a much more fundamental approach. And so we sort of encapsulate all of that information and we put it into let's call it the seed lab algorithm to determine whether or not the valuation is fair. And so it's a pretty mundane process for us, to be honest.
Really? Why is it mundane?
Just because it's untypical of what some of our other, sort of constituents or colleagues are doing from a valuation perspective. When I see a company and they tell me that their valuation is X, right? Is that an arbitrary number? They have to defend it. And for the most part, they try, but are they looking at some comps in the space? Are they looking at the right comps in the space? Are they, where are we from a cyclical, sort of standpoint for that business, depending on what category that business is in? Is there room for another company like theirs, in the market? Do they have the right personnel to champion, pushing this product into the right areas for the consumer? So I look at a lot of those sort of variables to help determine whether or not there's real value. From a financial perspective, I mean that's a whole other segment.
Jesse, you've obviously looking to, I would imagine, in some time in the future at least, get to an IPO or some kind of exit of some kind. So how do you evaluate or prioritize an exit when one comes available or manifests itself? For instance, a strategic partner wants to acquire one of your portfolio. Do you leave it up to the founders themselves, or how do you approach that?
Well, I mean, so from the Seed Lab perspective, we have not had an exit. Okay, we've had on marks, we're looking at a 6 to 8 on the portfolio, right? But that's on marks. Those are audited marks. But we haven't had an exit yet. But from other experiences, we are looking for strategic partners to come in when we feel that the company that we've invested in, and we're currently having these conversations with one of our portfolio companies now. Company started, we're the only investor, in the company. Okay, we own almost 25% of the business. They now have outside investors. They've now raised some real money with a really, really strong valuation to their business. They're doing all the right things, but they don't have the personnel, they don't have the know-how, and they don't have the relationships to take this company, which is now valued, at close to $150 million, that at some point we're going to have to sort of let go of the past and put the company into hands of people who have done this before, right? Who can now say, look, it's a 3 or 4 legged race, right? Lap race. And so it's now the passing of the baton. You've done the hard work. We're strategic coming in to take a look at your business. Now, buy your business or partner in your business. Thank you very much. We're going to take it from here kind of mentality.
Jesse, let's look forward then. In the next, well, when you think about how uncertain the whole space is right now, what would you say keeps you up at night when you think of venture capital and its future?
There's always that FOMO, right? I speak to a lot of people daily about a variety of deals and the markets and so forth. And, there's always that cluster of companies that, seem to get the most amount of visibility, the most amount of press. They're outperforming a lot of their peers. And when you're not involved, when you've seen it or you've heard about it, but you were undercapitalized, couldn't get involved, with that business, or maybe it didn't pass your diligence. And all of a sudden that company now is starting to accelerate, its growth and getting a lot of attention and so forth. That for me, I'm highly competitive. That for me keeps me up at night. Like, I don't want to miss the really, really good opportunities. And I also have a fear of missing out on not being shown, some opportunities that some of our, competitors are getting a first look at. So, it's important to constantly be out there, constantly be networking, constantly be talking to people, and for good measure, speaking to your founders about some of the things that they're seeing, whether it's in their particular, segment or in their vertical or in their space, about some of their competitors that are coming up that they're worried about, that they're hearing about, that they're looking at, because they're starting to demonstrate that they're doing some of the right things. And so, that's something that does in fact keep me up at night, Matt, is, I want to get a look at everything. And of course we can't see everything, right? You don't have everyone, but for the really good funds, the really successful funds, they see a lot of the good flow, and so you've got to sort of get out there, and you've got to sort of convince them that you want to be part of their of their rotation.
Great point. Jesse, when you think about the next 10 years of venture capital, how do you see it evolving, and what do you think its impacts will be on startups?
Well, look, I think what's happening in the macro part of this conversation, I think, look, we needed some kind of reset, right? And a lot of these companies had valuations that were just so unjustifiable. They were unrealistic, unreasonable, and unjustifiable. It was because everyone was sort of we were flush with cash over the last several years. Money was cheap, and some of the returns were astonishing, and so people were starting to invest in venture that had never invested in the private sector ever before, and so the valuations were skyrocketing, and so I kind of feel that this reset is going to make the venture space a bit more honest, right? It's going to sort of bring the best of breed, to top of class. And it's going to sort of eliminate a lot of these companies out there that are just taking shelf space from some of the bigger brands.
Yeah, zombie funds.
Yeah, and so what do I think is going to happen in the next? Look, if I could predict that, I wouldn't be sitting here. That's for sure. I'd like to think, this is going to be a very, very critical year for venture, because I do think that, with all the banking stuff going on. Let's see who the strong are, and if the strong can survive this. And I think it's going to create a lot of great opportunity. I think in the next year to 3, you'll see some really exceptional companies coming to market. It's going to create a really, really great, investment opportunity.
Jesse, I'm going to have a quick bit of fun with you. So I'm going to give you the keys to the Matt Brown Show time machine. So I'd like you to go back to yourself on day one, like no fund, but you wanted to get into the space, or you got the cash for it, and it's all very embryonic. And if you think about all the things you've learned and failed at since the beginning, what advice would you give yourself on day one about venture stage investing?
So, another great question, Matt. I would probably select my partners a bit differently. I really enjoy and appreciate and trust my partners. But at times I think maybe there was a bit of impulse. You want to bring people in. We brought a lot of operational experts in and around the seed lab. I would have been a little bit more selective in my process of who I brought in to help, start, our first fund. That's probably the biggest lesson I learned. Second is, you've got to sort of temper your impulse, right? As I said, I've seen over 200 companies in the last 4 years, and I've seen some really amazing founders. I've seen some really, really, great products, and companies that I think in a different environment would have done exceptionally well. I wouldn't have gotten so excited early. Like when I started to look at a variety of companies earlier on in my venture career, I wanted to give money to everybody, right? Like if I was overcapitalized or I had a lot more money than we did when we first launched, there would have been probably 20 or 30 other companies out there that would have had an investment from the seed lab. So being undercapitalized protected me. But, when we were in committee talking about, a variety of companies that we were thinking about investing in, I would have invested in a lot of things back then that I wouldn't invest in now. And that would have created, some issues and some problems for our fund. So call it the silver lining. But, it's very, very easy to get excited by a young founder. Their energy is always, really, really, captivating, and I'm drawn to that. I love a great story. I love how they came up with the name of their business. love how they came up with the idea, love meeting their team, love hearing about their enthusiasm. I get captivated by all that. So now I've got to sort of, and especially early, right? Like I root for the entrepreneur because I know how difficult it is, and I want to see everyone succeed. And so I got carried away with certain founders very early on that I wouldn't demonstrate those kind of behaviors now.
Yeah, you can't. I think your bullshit radar needs to, especially I suppose you're getting into the space if you had money to do. Like, let's just say I sold my business for $20 million and I wanted to put $1 million or half that into venture stage companies, $1 million each. Like my initial problem would be the same as you. It's like, like I speak to founders all the time, and I speak to some of them. Like yesterday, I spoke to the guy from Fireflies, Krish, and like you listen to him talk, and it's like, holy shit, man, this guy's gonna build a fucking unicorn. He's gonna like, and he speaks so well and this kind of stuff.
That's also something to answer, your question with, when we see founders and they come in and they say, and they use the word unicorn, or they say we're the next $1 billion business, I stop them right there and I say, look, you well, in fact, may be the next unicorn or $1 billion business, but I'm not here to go on that journey with you. Even if we love the company, because they're thinking in a way that's not myopic. They're thinking in that way where, back when I had the apparel business, when I was doing 15 million in top line, we had somewhere around 25% in free cash. So the company was making $2-3 million in that particular year. And it was a great, fun place to work, right? It was manageable. We didn't have a bloated, personnel footprint. Everyone liked each other. Everyone enjoyed coming to work every day. We all participated in opening up our stores. We all went to the runway shows. It was like a really nice community of people working in and around us. But at some point, you make this decision. The demand gets really, really, really intense. And you kind of make this decision, let's go for it. We're going to become the next big thing. And our top line grew. We were doing 47 million at our peak. But I was losing money at 47 million because now you're looking to get into other channels of distribution, whether it's direct, expand your wholesale business, possibly do some brick or mortar retail work, right? You need more people to run these initiatives. You have to have a little bit more product. You have to make sure that the style, the fit is all, well done. And so now you're looking at a much larger, payroll, a lot of people coming in. Communication has to be, really, really strong. You have to increase your systems, right? And you want to control sales, and it just becomes a lot. There are a lot of cogs in that wheel that make it go round. And, it's a very, very, very tricky thing. And so, people who are out there that come in and say, yeah, we've got the next unicorn here. This will be $1 billion business. I stop in and say, look, there's other funds out there that will probably be better off, or you would be better suited having on your cap table than the Seed Lab. Because I don't think you realize that only 1 in every 3,000 companies get to that unicorn status. And I don't think people realize how hard it is to get there. We read about those companies that have gotten there in a very, very short period of time. But there's a reason why we're reading about it. We don't read about the 3,000 or 4,000 other companies that can't get out of their own way, that can't raise capital, that have a great idea. They don't have the right management. They don't have the right skill set. They don't have the right tools to help them get to that point. And there's, to get from startup to $1 billion, there's a lot of hair on it.
Yeah, not all scale is good. And that's what I've learned. But Jesse, look, I could speak to you for quite some time, I'm sure. Unfortunately, that does conclude your time in the hot seat. Jesse, thanks for your time, man. It's been a privilege getting to know you a bit better and your background and kind of how the whole thing came together, and most certainly for your perspectives on private placements.
Well, thank you for having me. I'm honored to be on your show. It's a great show. You have a great reputation. You're doing a great thing for our community. So thank you very much.
Thanks, Jesse. Ciao.
Hey, Matt.